my fellow freedom builders, and welcome back to the channel. It is time for a quick overview of the markets. I would have made it this weekend, but things got a bit crazy, so here it is. First of all, we have of course an S&P 500 market that is going fantastically well, doing new all-time highs and all that stuff. And we can see right now in the futures market, from the end of the last day in 23 and up until right now, we're up something like 3%. Or are we? We'll have a bit of a look today at the earnings seasons, at some economic news from last week, and what is actually going on with the market. First of all, the earnings update. And this is, of course, the weekly update from FactSet here. This is from Friday. And as you can see, Friday, there was an overall of 46% of the S&P 500 companies that had reported actual results. Now, over the last 5 years, we have seen a 77% of the stocks that are actually outperforming the estimates. And when I started these earnings updates here, after the first week where only 10% had been released the actual earnings report, it really looked bad. There was a lot less that outperformed the estimates, and well, right now we are at 72% that is reporting above estimates on the earnings per share. That is only slightly below the 77% from the last 5 years, so that actually doesn't look too bad. Now, what I also said was that the overall performance above or below estimates, the last 5 years, the average have been that earnings have reported, or the companies have reported 8.5% above estimates in earnings. And when we started out the first week with 10% of the S&P 500s had reported, we were 18.5% below instead of 8.5% above. That really made me a bit scared about the rest of the earnings season. However, the numbers have come in and we are close to 50% of the companies, and right now we are getting closer to the 77%, that is the average over the last 5 years. And if we are looking at the aggregate, the totals of the earnings, they are actually now 2.6% above estimates on average. That is not as good as the 8.5%, but it is a lot better than the 18.5% negative. So I'm a bit more comfortable in the chair right now. I'll let you go through the report yourself. Just, well, I can put a link to it below the video, but you can always find it on FactSet and S&P 500 earnings update. There you can see a lot about the different sectors and so on and so forth. I just want to say that it actually doesn't look as bad as it did after the first week. Also, last week, of course, we got a ton of we got inflation numbers and all sort of stuff, but the really big number was, of course, the non-farm payrolls. How many new jobs were created in the United States? And first of all, this number from the month before was actually revised up quite a bit. So they did count up the numbers again and found, oh, we forgot some numbers, some jobs lying around here. So it actually was revised up quite a bit. However, it was forecasted that only 180,000 jobs would be created last month. And that was really beaten. It was 353,000 new jobs. Remember that a rule of thumb is anything above 100,000 is a sign of some good activity in the economy. So 180,000 new jobs would actually still be quite decent and a sign of an expanding economy in the United States. But 353,000, that is insane. Employment rate stayed at 3.7%. And of course, there are some details down here. You can see that the average hourly earnings year over year is 4.5%. Now, considering that the inflation right now in the United States is somewhere between 2 and 3%, depending on what number and who counts it and everything, then it actually tells us that there is a real increase in payment. So that normally when you're looking at your payment, if it goes up 2% but the inflation is 3%, then your real payment is actually decreasing. But here it is increasing, so the US consumers are getting more money in the hands to buy stuff with. So that is good. Or is it? Because we do want the economy to be on a bit of a slower pace maybe, so that inflation doesn't creep up again. And definitely what we saw here, these numbers, if we just have a quick look at the FOMC countdown here, that is where we can see how the swaps are priced in, what they think the probability of the different interest rates are. We can see that in the March meeting, the Fed meeting in March, we can see that there's now an 84.5% probability of the interest rate staying at the same. Now you can see a month ago that was only around 32%, now it's 84%. And that is because there's so much activity in the economy that Fed actually have the maneuver room to just not lower the interest rates. What if we go to May? What do the market think? Well, they think there is an overall higher probability for at least one rate cut here. But as we have seen, that can easily change. If we go to the June meeting, okay, almost no one believes that we'll stay at the same interest rate. And I think that is reasonable to say that we will have seen at least one interest rate cut at this point. However, if we're looking at the interest rates, then this is on a daily chart. This is all the different yields up here from 1 month, 2 months, 6 months, 1 year, and up towards 30 years here. And we can see on the numbers Friday, the interest rate spiked up, meaning the bonds were dropping. And that is, of course, due to the market anticipating that Fed will keep the interest rate higher for longer. Now, how does that affect the markets? Well, it seems like it isn't affecting the market really. However, as I said at the beginning, we can see here from the end of the last day here in 23 and up until now, this is the price in the futures market. The S&P 500 is up 3.1%. However, as you know, the S&P 500 is a highly weighted index, meaning that there are 5-10 stocks that are doing maybe 50% of the overall weight. So if just they go up, they will drag the S&P 500 up. So let's try and have a look at the product called RSP. It's an ETF that is a so-called equal weight ETF, meaning that every single of the 500 stocks in the S&P 500 has 1/500th part of a share in this. So they're completely equal weighted. Now, what do we see here? Well, in the same period, the market is up about 0. So the market is actually in break even. What looked to be a good uptrend, looking at the weighted S&P 500, seems like not as good a trend here in the equal weighted. Now, what if we look at the Nasdaq? It is not quite as dramatic, but let's have a look. The Nasdaq here since the end of 23 and up until now shows us a 4.6% up here approximately. If we're looking at the equal weighted, we can see that instead of 4.6%, we are at 2.2. So that is also about half the increase in price from the normal Nasdaq into the equal weighted. What I'm saying here is not that this is not necessarily terrible. It's just to say that if you are sitting with some stocks in your portfolio and you're not owning the Max 7 or FANG stocks or whatever they are called, but you're owning a bunch of other stocks, then you might realize that your portfolio is not going up quite as much as the market, because we're starting the year basically in the same way as we did last year, with all the larger stocks just dragging the market along and actually the underlying market not doing quite as much. I will keep track on this to see if this changes. It did last year in the last quarter. But let's see what happens, and I'll give you an update again in a week's time about the earnings season and how the economy is doing. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.